Hi, I'm Karen Osborne, Chief Investment Officer at Mission Wealth, and today I'll be discussing the importance of a multi-strategy approach to investing, which incorporates both active and passive strategies. What is a multi-strategy approach? When considering various investment options, be it mutual funds, exchange-traded funds, or other types of investments, most investment strategies fall into one of two buckets: passive or active. A passive strategy typically employs a low-cost approach to investing, usually following an index or enhanced index methodology. On the other hand, an active approach to investing aims to utilize manager skill to outperform within certain areas of the market. Active funds tend to have higher expense ratios than passive funds to compensate for the additional layer of manager input and oversight. Importantly, we believe there is room within a portfolio for both active and passive funds, and we believe incorporating both passive and active approaches where it makes sense may ultimately enhance the long-term returns of a broadly diversified portfolio. Within highly efficient markets, we employ passive strategies in the form of low-cost index solutions. US large-cap stocks are a good example of a highly efficient market. So why do we choose to invest in low-cost, index-based strategies within US large cap? Well, empirical evidence shows that on average, active managers do not add any value within this asset class. In fact, over extended periods of time, active managers, on average, have a very poor record. As this chart illustrates, between 80 and 90% of all actively managed funds underperform a passive benchmark, in this case the S&P 500, over 5, 10 and 15-year periods. You can see similar results hold true for mid-cap and small-cap US stocks. Taking this data, at best you have a 20% chance of picking an active manager who will outperform in the forthcoming period. Oh, and by the way, there is no correlation between past performance and future results. In fact, many of the best performers in one time period may end up being amongst the worst in subsequent time periods. For this reason, we believe an index-based approach to investing within US large cap and other similarly highly efficient markets has a better chance of outperforming actively managed strategies. So where do actively managed funds make sense within a portfolio? We believe less efficient asset classes, such as high-yield bonds, emerging markets debt, or direct credit, are best suited to an actively managed fund approach. Think about the efficiency of an asset class this way. If you asked any of your friends whether they have ever bought a stock, almost all of them would reply yes. However, if you ask that same friend if they have ever bought a high-yield bond or an emerging market bond, the reply would be much different. Simply put, high-yield bonds and emerging markets debt, along with direct credit, are all examples of much less liquid and therefore more inefficient asset classes where employing high-quality active managers may add value. As an example, our preferred high-yield bond manager has consistently outperformed more than 80% of peer group funds over extended periods. We believe utilizing a multi-strategy approach to investing, incorporating both active and passive strategies, and being thoughtful about which asset classes are best suited for each type of approach, may ultimately enhance long-term expected returns within our clients' broadly diversified portfolios. I'm Karen Osborne, Chief Investment Officer at Mission Wealth, and this video discussed the importance of a multi-strategy approach to investing which incorporates both active and passive strategies. For more information, please visit missionwealth.com or contact your client advisor.